Good afternoon, folks. I think I sent a small snippet in the morning on a Facebook Live. As stated before, I'm going to talk. There's a lot of buzz in the market. Everybody's talking about interest rate hike, and today we are going to cover a lot. Like we are going to recap about inflation and the rate, what I discussed about few episodes back, and discuss the relationship to the GDP and rate. Basically, I will talk about what drives the rates up. There are several indicators, but I'm going to pick up only few indicators which drive the interest rate up. And it's very important to know why the rates are going up. We should not discuss something without knowing the root cause. That's the reason I want to touch on those indicators initially. Then the second, I'm going to talk about Bank of Canada rate increase system, how they, when they increase and what's the reason they increase and stuff like that if I get a time. And also, I will talk about the overnight lending rate and a prime rate. Discuss few nuances between these two rates. And a fourth topic which I'm going to cover is what does mean to you the rate hike by Bank of Canada. And finally, I'll be acting like a Nostradamus. My prediction for this year about a rate hike. These are the topics I'm going to cover. Without further ado, if you like what I say, please comment. That was really encouraging me to do more shows and more episodes like this. And if you want to comment, please, if your views, feel free to share on this particular platform. We are live on Facebook, and also I believe we are live on my YouTube page. And if you go to my YouTube page, please subscribe that bell button. And I don't have many subscribers on YouTube, but I have many followers on Facebook. I want to have an equal participation in the both platforms. All right. So today, before I talk about interest rate hike, um, I know let us understand why rate has been increased, why the rate has been increased, what is the relationship to the interest rate, GDP, and inflation. All right. I spoke about the relationship with to inflation and interest rate last time. Go back and refer my episode. I think about 2, 3 episodes back. I spoke about it. Refer what I said and what is happening. Do your fact check. It is exactly the same thing what is happening today. When interest rates are low, the economy grows and inflation increases. And Canadian inflation surpassed, it's not a good sign, 5% for the very first time since September 1991, raising to 5.1 on a year over year basis. So since September 1991, this is the highest inflation we have seen uh, this time in 2022. What I'm talking, okay. Go back to my episode when I spoke about inflation. When I spoke about inflation, the inflation rate is around 4.8%. It is in an incline, increase mode. So it has gone up to 5.1. It has surpassed 1991 number. Okay. When the interest rates are low, economy increases. And now let us discuss relationship, the economy, what drives the economy, or GDP and a rate. Before we discuss, let us understand what is GDP. The GDP is gross domestic product, which means the total market value of the goods and services produced by a country's economy during specific period of time. So, as I said, when the interests are low, interest rate is low, economy increases. And in a matter of fact, Canada is the world's 10th largest economy as measured by GDP. Okay, an increase in real gross domestic product, okay, will cause an increase in average interest rate in the economy. Once again, when the GDP grows, interest rates increases. All right, annualized GDP for the fourth quarter of last year was stronger than expected in Canada. It grew 6.7%, and 2021 was the year of the recovery for us. All right, and if the economy is struggling to grow or experiencing a shock, as it did during COVID-19 pandemic time, the bank can slash interest rate to help boost economy activity. When the overnight rate falls, people and businesses pay lower interest on a new and existing loans and mortgages, and they can earn interest on saving. This generally leads them to spend more, which in turn helps strengthen the economy. And also, an economy that is growing too quickly can lead to a high level of inflation. That's what we are seeing today. Rates were low, people spend more, injected that into the economy, and the GDP has grown, and now that's the reason inflation also has gone up in the country, and they have to increase the rate to balance out these indicators. The bank might raise overnight rate, forcing people and businesses to pay higher interest loans and mortgages. This discourages them from borrowing, reduces overall spending, and typically brings inflation under control. And we are talking about the interest rate hike system. Back in November 2000, the bank introduced the system of 8 fixed dates each year on which announces whether or not it will change the target rate. Strictly speaking, the bank rate and the target rate of Bank of Canada, prime rates, are all the same. There are a few nuances. We'll talk about it later. It's only this is the small few nuances. Only the prime rate that is different. All right. And we already seen 2 announcements this year. That means we are left with 6 more announcements. And what is going to happen? What will happen to the Bank of Canada's rate? What is my prediction that I will talk about towards the end of this episode? And just for your information, these are the interest rate announcement dates. We have 2 of the announcements already done on January 26th, March 2nd, and the future announcements are on April 13th, lucky for some, unlucky for some, and June 1st, July 13th of this year, September 7th, October 26th, and December 7th. And they fall on the same day. This generally interest rate announcements are done on Wednesday. All right. So interest rate is the cost of borrowing money or the compensation for assuming the risk of lending money. All right. It is a cost for one party and income for other party. Increase in demand for the credit will raise in interest rates. Decrease in demand for credit will lower them. As the supply of credit increases, interest rate decreases. Also, it is the other way around. And we are talking about prime rate. Prime rate is driven by the overnight rate as set by Bank of Canada. The overnight rate is rate at which bank lends to each other. That's the reason you see there is a difference between the overnight rate, which is lower, and the prime rate is slightly higher. Banks has to make money by borrowing that money from the Bank of Canada. The prime rate in Canada is currently, which is after the increase, it is now 2.7%, and a prime rate is the interest rate that bank and the lenders use to determine the interest rates for many type of loans and a line of credits. What does it mean to you? That 0.25% rate hike how that has impacted to the consumers. Okay, I will talk about it next, and also I'll summarize it. People, you don't have to worry about this small rate hike. It is not going to do a major impact in your life. I will break down the numbers, and I'll tell you how much it's going to cost you for if you have a 400,000 mortgage. That's the average mortgage Canadians they have at this point of time. Okay, rate will go up for now. It is. I mean, if this is going to happen entire going forward entire this year, and I'm forecasting there will be about 3 rate hikes this year. And let's go back and revisit on December 31st what I said and what really happened, and we'll do the fact check. This is my only my prediction. I'm entitled to talk about it or using my experience. Okay, there would be a 3 rate hikes, which equates to about 1% hike in coming years. What I'm trying to tell is, do not panic. If you are on a variable space, if you're a variable customer, variable client, don't panic and fix it. You'll be jumping from pan to the fire. Let it be there, and it is just every 25 basis points increase or 0.25% increase will cost just $50 in your monthly payments. $50, it is not going to make or break your life. You can cut down somewhere else and pay it here, or save this. I'm going to talk about it, how you can save money for these unforeseen situations. And if you have affordability issues, there are solutions. Please contact your banker or your broker. They may be able to help you. If you don't get help from them, you know where to contact. You can always come back to us. We are more than happy to help you. But first, go to your banker, go to your broker, tell your situation. They have many solutions to you, and once they offer all these options, select the best which suits you. Sorry guys, my voice is drying. Sorry for that. And a lot of people asking me, should I buy real estate? Rates are going up. What should I do? If you can afford it, buy it. That's it. Just buy the house. And if you can't afford it, don't buy the house. Be wherever you are and just continue or plan some strategies to buy the house. Go back to your banker or a mortgage broker, sit with them and talk about the strategies. If you cannot afford today, how can they make it happen in the future? What are the roadmaps you have to take? What are the steps you have to take? And what are the long-term goals you can have? And discuss those things with your banker and a broker. And once again, if you can afford, don't wait to buy real estate. Buy real estate and wait. Okay. With this, as I told you, with this rate hike, what is going to happen? It's just $50 a month payment. Do you think it's a big thing? But we are making a big things out of it. And I'll just want to share about a prime rate. It's a little bit scary, but I'll do my best to share the historic Bank of Canada's rate hikes. As you see in the slide here, and it has gone sometime in early 1980s. It has gone as high as 22%, as you see in the slide, and then it dropped, and people have lived with an average of about 6% Bank of Canada's rate. We are used to pay those interest rates, a low interest rate. Let us get used to spending a little bit more on interest rate, and let's get the inflation down, and let's get our goods and products what you are buying. Let's get those prices down too. And finally, as I said, a few things to keep in mind. Keep some additional funds, guys. I mean, there will be this additional expenses with the rate hikes, you may have to incur in coming days. There will be increased grocery bills you may have to pay. There will be a fuel cost you may have to bear. All these factors considered, and keep some money aside for your future spending needs. And if you don't have that plans, as I said before, go back to your banker and your broker. They have many solutions. They will be able to help you. If not, cut somewhere and save here to compensate this additional cost. I hope you liked my episode. I know it is a very complex subject. I'm not sure whether you got my message clear enough. I done my best to give you my understanding about interest rates, GDP, inflation, their relationship, and all these things. And if you still have some questions, please write and let me know. I'm more than happy to answer your questions. By the way, I'm also doing a webinar tomorrow at 10 o'clock sharp, how to pay off your mortgage and retire in 15 years. Please do join, and my colleagues will be posting the registration links on all these platforms. Please do register. Without registration, you'll not get a link. That's the only requirement to attend the webinar. I'm not going to ask you any money, or you don't have to sign up for any course. Just purely is the information I'm sharing, and will not chase you after that. Just keep that information, share with others, and help others. That's the only intention of this webinar. Thank you for watching, and see you next week, hopefully. Same time, same place, with different topics. And hope it's useful for you. And if you think that there is some value, you got some value out of it, share my videos to your friends and families. Cheers. Beautiful day outside. Enjoy your weekend. See you next week. Bye-bye.